On today's show, 3 questions. Number 1, what's happening in Japan? Number 2, should you be making extra payments towards your student loans right now? And number 3, what is the biggest risk to your investment returns? Let's go. Welcome to Dennis Money's 2 Cents, where we help Dennis navigate all the noise. I'm Matt.
I'm Taylor.
And I'm Rabih.
There was still a little hesitation there, Taylor. we practiced.
I was like right on it. I don't know what's going on here.
Oh, man. That's all good. Good to be here, guys. Guys, it is International Women's Month starting today. We are recording this Friday, March 1st. It is International Women's Month, so congratulations. Not to us. We decided to go with 3 men on the show today on International Women's Month, but here we are. I only had to bring this up because I was getting crap from some of the ladies in the office for not having it be the very first thing that I said when I came into the office. So they're calling me out. So I am now giving an official shout out on the show. Happy International Women's Month to all the ladies out there. I'm trying to make up for it. I'm going to make sure they listen to this.
I will say we did just release a very, very good Women's History Month podcast. And
did you listen to it?
I listened to it yesterday and I was like, this is amazing. This is great.
I thought it was great. That's honestly, truly, no jokes here. Full shout out to Victoria and Megan. They did all the prep for that. They built an incredible outline. I was just there, basically, and they carried the show. They were amazing. So more to come on that, by the way. The little teaser. We're going to start doing more kind of women and wealth series type stuff. So more to come on that. But either way, let's jump in. First question here. What is happening in Japan? Rabih, hit us. Hey. It better be. Is this going to be about sushi, hopefully, in some way?
I wish it was about food, but unfortunately it's about economy,
investing,
and financial markets. Yes. So in the last month, 2 major things happened in Japan. I'm going to tell you what they are, but then we're going to talk a little bit about the history of Japan, what they've been going through, and what led to what they are now. So around 2 weeks ago, Japan's standing in terms of economic ranking dropped from the 3rd largest economy to the 4th largest economy, where Germany took over. That's the first piece of information for you guys. The second piece of information, the Japanese equivalent of the Dow Jones Index, it's called the Nikkei 225, just hit this week its all-time high since 34 years ago. So that's another story for you. And you would think those should go in the same direction. If the economy is now smaller compared to other countries, you do not expect the stock market to do great and make all-time highs 34 years later. So let's talk a little bit about the Japanese history since the early 1990s and see where we ended up now. So to give you just a little bit of context, in the 1990s, Japan's economy was the 2nd largest in the world, a strong economic boom, and a big bubble in financial assets. That bubble bursts. A recession hit the Japanese economy so bad that there was a huge liquidity crunch. Banks could not loan, and the economy went into a recession that was followed by a prolonged period of deflation.
For 30 years, right?
For 30 years, 34. Yeah, it's only been 22 months since inflation is actually above 2%, which is the Japanese target. So while the Bank of Japan, BOJ, we have the Fed, they have the BOJ. While the BOJ intervened by pumping money into the economy, by keeping real interest rates below 0, by even investing in small companies themselves, they were not able to ease the financial situation to an extent to kickstart the economy back up. And that was because of the aging demographics that the Japanese population was facing. As a bigger portion of your population is in the older age group, where their productivity is much lower and the labor supply coming into the country is much slower because they weren't having kids, you would expect naturally, due to natural economic forces, for the economy to start slowing down. So regardless of what the Bank of Japan tried doing, it could not overwhelm, the fundamental economic story that the economy is going to slow down when you're not making new kids and when you aka you're not increasing the labor in the economy.
You're not making new kids. You got to make new kids.
You need to make new kids. Well, increasing the labor in the economy comes through ways. Either you go make kids or you just open immigration, right?
Yeah.
Only Rabih would talk about raising children as making kids.
Pure economic
Yeah.
perspective. So given that the labor supply was not increasing and the labor productivity was not really, there's a cap on it by technology, was not really growing much, the economy went into deflation. So I know in the US for the past year and a half, we've been talking about, hey, inflation is high, we really hate it. But it's, it's under control. Well, and when we are fighting it, it's still better than uncontrolled deflation.
You're saying it could be worse.
It could, yeah. Uncontrolled deflation could be worse, and this is what's been happening to Japan. And no matter what they did for the last 34 years, they could not create a rapid economic growth or an economic growth that was faster than what, potentially their GDP can offer to actually trigger that inflation and have inflation show up. So it took a huge shock to global supply chains, and it took, aka COVID, and it took a lot of other economies around the world increasing their interest rates while Japan keeping its interest rate low. And it took, as a result, the Japanese currency to fall to the lowest levels it's ever been vis-a-vis the dollar for inflation to startlingly tick up. And
it also took 35 years.
And it took 34 years. And that is a very good signal for the Japanese economy, because now it is on track to, out of its economic slump. And it's really, no matter what Japan did internally, it was external factors that allowed it to finally come out of this deflationary period. So the fact that the Japanese yen is now at its lowest levels, let me just give you some context. So for the last 3 years, if you compare them, the US dollar vis-a-vis the Japanese yen has increased 35%, which means a dollar 3 years ago could buy you 35% less of what it buys you now. So in currency terms, the dollar yen rating usually hovered around 105, 110 yens per dollar that you have. Now each dollar buys you 150 yen. And since currencies became free floating, this is actually the high. It matches the highs of around the dot-com bubble and in the 1990s. So that's one. And
so really quick, Rabih, can you talk about the impact of that? Kind of the so what of that point?
Yeah. So the so what, other than the fact that now Americans can go and have really cheap tourism in Japan.
I was going to say,
I'm going to fly there
Disney.
Tomorrow.
Tokyo Disney.
I mean, I'll skip out on the Disney part, but I've always wanted to go to Tokyo. Yeah.
You can go there, have as much ramen and sushi as you want for really cheap prices, given the difference in the exchange rate. This is for the consumers. But for investors, especially global investors, this is actually something good, because you would expect currencies do have the tendency to revert back to the mean. So for global investors, where they are pumping their money now into Japanese equities, and this is what Warren Buffett has been doing for 3 years, by the way. He would borrow from the Japanese government, put them in Japanese stocks. So the fact that you are pumping your money into Japanese equities, you would expect your return to actually be much higher and much better when the currency reverts back. Because as you're translating your returns from Japanese yen back into the US dollar, the fact that the Japanese yen went up along with the equity prices of Japanese stocks actually, makes the return much juicier, much nicer. Great for global investors.
Juicy returns, yeah.
Juicy returns. So part of the reason why the Japanese index is now up at an all-time high is because of all the fund flows that are coming from global investors. And on top of that, there is the fundamental story that, China has been also in a recession since COVID happened, and there are geopolitical risks. So Japan might be the alternative to produce at cheaper labor costs right now, simply because the currency is lower. So there are more than one factors, all external, that are helping revive the Japanese economy. But this is also definitely far away from the story of the country is facing a demographic shift, and that shift puts a deflationary pressure on the economic growth. So it might not last a lot, but it is a breather after 34 years for the Japanese economy.
After 34 years of deflation and horrible returns, I think this story here is what we talk about all the time, coming back to these like kind of first principle thinking, is just, and again, the ultimate like eye roll, here goes Matt again comment, but diversification, right? And that's what I'm thinking about. And specifically when we talk about, because right now, if we think about what the U.S. has done from a returns perspective for the last 20 plus years, it is really easy to say, and we get this from time to time, and I think it's a natural question, which is, well, why shouldn't we just put everything in the U.S.? Why would we ever globally diversify? Even more specifically, why wouldn't I just invest everything in NVIDIA? Like you can get, right? It's like, so and again, these are natural questions and understandable thinking. But for more context here, and Rabih, I don't know if you have these numbers, but we can kind of allude to it. I don't know if people realize the power that Japan was, like the power of the Japanese markets prior to this, going into the 1990s. Their run was historical for whatever, 20, 30 years prior to that point. They were kind of like the world power and the economic kind of like number one for several decades, right?
Yes, and that same, I'd say, emotional reaction American news listener here get when they are learning about how strong the Chinese economy is and how the Chinese economy might take over, that same conversation, word for word, was happening about Japan in the late 70s, early 80s. Japan is going to take over the US. They are much more efficient in how they are producing. They're going to take over, but due to, demographic and economic purposes, Japan was not able to keep up with the pace of the growth in the US.
Guess who's won both those battles, Rabih? America. You know what I'm saying?
Yes.
But no, it is just a good lesson here for an historical context. It's so easy to get lost in the recency bias. It's so easy to get lost in looking back and saying, oh man, we're so dumb for not just putting everything into this or that company, or in this case, just a global, into the US, right? Into a certain region of the world. Right now, the US has dominated. But look, we've alluded to this as well, even for outside of Japan. Let's focus on the U.S. for a second to give some more context. People don't realize from 2000 to 2009, the lost decade, the U.S. was the worst place to invest for that 10-year period. It was something in the ballpark. It was the first or the only 10-year period where you would have literally lost money in the S&P. The worst 10-year period, even including the Great Depression.
Yes.
If you would have been globally diversified and actually invested outside the U.S., you would have averaged somewhere in the ballpark of like 7.5% to 8% per year over that 10-year period. Numbers aren't exact here, but something in that range. So again, we just, as we say, navigating the noise, we're trying to give some context here to say it's really easy to look back. It's really easy to say, man, we should have done this or that based on these results we now know. But it's talking about the story about Japan, it's really, really critical to have that historical context and realize why we advocate so much for global diversification as like a fundamental principle of investing.
Exactly. And actually returns from Japan lately has been as good as the US, if not better, or else it wouldn't have caught up to its all-time highs. And this gives us a big lesson in risk management. Maybe, Americans have been spoiled because the US has been doing well. But if you come to an American and you tell them, do you expect the S&P 500 not to make all-time highs for 34 years? They'd just shrug it off. But this happens.
This is what happened to Japan.
Go into a direction. It went to Japan. I think our Japanese listeners would most love to tell when we tell them, hey, invest globally in the US. We don't have Japanese listeners, but if we do,
all of our Japanese fans,
all of our Japanese dentists, they would tell us, they would be very thankful when they hear that we tell them you need to have a US part in your portfolio. And likewise, I would say our American counterparts will want to have exposure globally in their portfolios as well.
Yeah. Well, and the last thing on this is we've talked about this also before. The idea of home country bias. This has been very well documented. Studies done on this. Australian investors focus most of their portfolio in Australia, Japanese mainly in Japan, U.S. and U.S. And again, it makes sense. You kind of invest in what you think or what seems familiar. But again, just highlighting the risks of doing that. And I like what you just said, Rabih. Like, risk management is the key. It's survival, right? It's like the big returns get all the press, but really over time, it's about how do you mitigate risk? How do you survive? How do you not blow yourself up? Is the whole key to this. So, okay, hey, Rabih, anything else on the Japanese story?
No.
Okay. Taylor, I know you mentioned your camera's off. Are you still there?
Yes.
Okay.
I'm still here. We're just getting some connection issues, so I'm hoping the camera being gone will improve that.
That's okay. I don't love that I can't look at your face. I kind of enjoy looking at your face.
You're not
but that's okay. As long as I can hear your voice. Let's jump to you. Let's talk about should you be making extra payments toward your student loans?
Yeah. So just some background on this. I talk to a lot of dentists. Who have all different ranges of student loans, right? And what I found as a rule of thumb is that a lot of people are doing things, well, I don't want to say incorrectly, but let's say inefficiently.
You can say it. You can say
inefficiently when it comes to their student loans, right? And I think the biggest problem isn't necessarily, I think the biggest problem is just that there's so much and it's so complicated that people just don't understand what's happening. And they hear some general advice about student loans and they adopt it in their own situation. And I'm going to make this my moniker. Good general advice is horrible specific advice. And that's very, very true, specifically with student loans right now. So I want to paint a picture. 2 people in the last week have come to me under the new SAVE plan. So I think it probably makes sense to explain the SAVE plan again, because there's just a lot of misinformation and confusion around the SAVE plan. So in order to understand the SAVE plan or any income-driven repayment plan, we need to understand the standard repayment plan. So if you come out of school and you have any student debt and you don't do anything with that debt, you are auto-enrolled in the standard repayment plan. Right? The standard repayment plan is a 10-year debt schedule with an interest rate, a balance, and you make a even payment for 120 payments until you pay them off, right? That payment is comprised of a certain amount of interest and a certain amount of principal, right? But, for example, the average dentist, what would you say, Matt, the average dentist student loan balances are right now?
Oh, I would say probably somewhere in the ballpark of 350,000.
That's where I would put it. I've seen 350 is a pretty common number coming out of school these days. And I've seen a lot of more expensive schools in the 500. So it's not uncommon that you see 500. And if you go get a specialty, it's not uncommon that we see 750 to 900,000 if they go and do an endo residency or a pedo or an ortho. Right?
I mean, we've seen 7 figures. Yeah.
So as you can imagine, if you come out of school on a 10-year payment plan with 300,000 to 400,000, we're talking 3,500 to 4,000 a month in a payment. For a lot of people, that's just untenable. They can't make it work. So that's why these income-driven repayment plans exist, right? But the downside of the income-driven repayment plans is they're not based on interest. They're not based on principal. The payment is completely derived based on income. So depending on whatever your income level is, the payment that you make on this plan may or may not cover the interest owed, right?
Yep.
So this is important to understand because your interest will still be accruing regardless of the income-driven repayment plan you're on based on that 10-year AM schedule, right?
Yep.
So some quick numbers. I'd say on average, most dentists average student loans interest rate average around 6%. Is that what you see?
Yeah, I think that's probably pretty fair right now. Mm-hmm.
Some higher, some lower, but let's just say 6%, right?
Yep.
So on a 10-year loan payment, it's it's funny that it works out this way, but it's literally per 100,000, it's $500 a month of interest per 100,000. So 200,000 is 1,000 a month in interest, 400,000 is 2,000 a month in interest, right?
Yep.
So you owe 2,000 a month in interest at 400,000 of loans per month, right? Regardless of the payment you're making on an income-driven repayment plan. So let's say right now, which is the case for a lot of dentists that graduated within the last 3 to 4 years, your payment is zero under an income-driven repayment plan, right?
Mm-hmm.
So if we're making a zero payment, we still owe $2,000 a month in interest. Now, how this $2,000 a month of interest unpaid is handled is really the main difference in these income-driven repayment plans.
Robbie, do you have something?
No, I'm just crunching.
Oh, you're thinking about it. Okay.
Yeah.
Got it.
So let's go back to pay. Matt, $2,000 a month of unpaid interest. Under pay, how is that handled?
Oh, you're going to call me out. I don't know,
Okay.
Taylor. You're going to have to share with me.
$2,000 a month under pay. So again, we're making a zero payment in this situation. We owe $2,000 a month in interest. Under pay, that $2,000 a month of unpaid interest was capitalized to your loan. It was added. It was accruing. So you get the benefit of not making a $4,400 a month payment in total, but we'd be adding $2,000 a month in extra loans under the pay plan.
Yep.
Right. So it was a benefit because we didn't have to pay as much, but we were adding loans. Then we had Repay, which was a revised pay-as-you-earn income-driven repayment plan. That was, hey, again, same situation. We're making a zero payment. We have $2,000 of interest. Well, half of it was being added or accrued, and half was being canceled every month. Right?
Yep.
Under the new SAVE plan, all unpaid interest is being canceled. Right? So every single month, we are being forgiven or having our interest canceled of $2,000 a month in this scenario. Right?
Yep.
Which is amazing.
Huge difference. Yeah. Massive.
Huge difference. So basically, under the SAVE plan, your loan balance cannot increase at all. Right? It cannot, because any unpaid interest is being forgiven. Right? So that's the situation we're in. Well, there's some good general advice out there that you should be aggressive and you should pay down your student debt. So what I'm seeing is a lot of people have an extra $2,000, $3,000 a month, and they're saying, okay, I need to pay down my student debt. So let me pay $2,000, $3,000 a month to my student loans.
Yeah.
But what's the issue here? Well, the issue is this unpaid interest is canceled at the end of the month. But if you make a payment in the month, guess what you owe now?
You're going to tell us, aren't you?
The principal drops by the 2,000?
You owe $2,000, right? So if I'm making an extra $3,000 payment, I still have to pay my interest owed for that month, right? So I think I'm paying $3,000 a month towards principal. Really, I'm actually paying the interest that I otherwise would be subsidizing.
Would have been forgiven anyway.
Exactly.
Yep.
So you're not making the amount of headway in your loans as you would otherwise.
Got it.
So making extra payments, I like to, I'm coming up with my own terminology here because this stuff's confusing. But your interest, right, that you owe every month, the unpaid interest under SAVE plan, is what I call your interest threshold, right? So if you are under this interest threshold, then you are not benefited paying extra on a monthly basis under your student loans, because any extra you pay has to be applied to that interest that would otherwise be forgiven.
And Taylor, underpay, there's no way for you to direct that extra payment towards principal, is what you're saying. Like if you make an extra payment.
So you
owe, sorry, under the SAVE plan.
Under SAVE, yeah. So you owe first that interest that's accruing for the month, right?
Yep.
So if you pay extra, so let's play this scenario out. So if we're paying $3,000 a month extra to our loans, but we owe $2,000, right? Well, then we first every month have to pay $2,000, and only $1,000 is going towards principal.
Got it.
So over 12 months, we're making $12,000 of headway, paying $36,000, right, over a 12-month period.
So you're paying
$3,000 a month.
You're paying extra in interest that you don't need to be paying, basically.
That you don't know. So now let's take A better, more efficient way to do this is, let's say we put that $3,000 a month into a high yield savings for 12 months. And then at the end of the year, we lump sum pay down in 1 month, a chunk. Right?
Yep.
What would happen is for 11 months while we are making our zero payment, that $2,000 a month of interest is canceled every month. So we don't have to pay it, right? It's gone.
You just saved 24 grand.
You saved 24 grand in interest. And then in, let's say December, right? The 12th month that you did this, you put in the 36 grand that you'd set aside for this. Well, you only owe $2,000 in interest in that month. The rest of that amount is going towards principal.
Got it. It's
right?
A pretty significant swing.
So both situations, you're doing $3,000 a month, right? But if you choose to pay it monthly, you pay the $24,000 in interest. You make $12,000 in principal payments. If you just put this in a high yield savings account and pay it in a lump sum at the end of the year, you pay $2,000 in interest and $34,000 in principal.
Dang. Yeah, that's a huge difference. Holy cow.
And I've seen this happening more times than it's just every time I see it, I'm like heartbroken because this person thinks they're making extra payments, they're scrimping, they're saving, trying to get ahead, and they're just paying off interest that they otherwise would owe. Right?
Yep.
When a better way to do this is to just save it, set it aside, and make sure you're making lump sum payments.
Yeah, that's really interesting. And not only that, we've talked about this a lot before. I love this strategy, Taylor. And in this case specifically, you're highlighting on the save plan. I lose track of literally all the acronyms the government uses for this, like pay, repay, save. But on the save plan, by doing this, you're actually saving on interest significantly, is what you're highlighting here. But the other reason to do this, even with other loans, we've talked about this of as opposed to making extra payments, putting it aside, in this case, a high yield savings account, it also is giving you maximum level of flexibility. And or at least talk about coining terms, what I've always said on this is like change your mind insurance. Like that's really what that is. So at the end of the year, you can decide you've got this 36 grand piled up. You may or may not want to do that. Something has changed in your life potentially. Yep. And so I like that strategy way more, not only from the savings you're talking about, but from the optionality it gives you.
Yeah. Well, and I think we're very open as like, hey, maintain flexibility early in your career. Don't be in a hurry to pay down your student debt. But some people are going to choose to do it, right?
Yep.
But my thing is, if you're going to choose to do it, just do not do it on a monthly basis right now. If you are on a save plan and you're below your interest threshold, right? So simple math here. I've been throwing around a ton of numbers and you're not seeing anything, so you may be lost. But simple math is you per 100,000 of loans that you have right now, you owe an interest under any income-driven repayment plan about $500 a month per 100,000, right? So if you have 200,000, you've got about 1,000 a month in interest, right? If you've got 300,000, you're at 1,500 a month in interest, right? So if your payment is below that interest owed, there is no benefit to you to be paying extra on a monthly basis.
Yeah, right? that's a good recap there. Mm-hmm. If you're on the save plan and your payment's below that $500 a month per 100,000, then there's your indicator. You should not be making extra payments under save.
Yep. And if you want to make extra, do it, but do it on a lump sum basis. Do not do it on a monthly basis, because otherwise you are paying the interest subsidy that you otherwise would be getting. And there are so many people, not just Dennis, so many people with student loans right now that don't realize this, that here, it's a good idea to pay down your student debt and are applying it to their situation, not realizing that they're forfeiting this incredible, massive gift that they're getting from the federal government in the form of interest subsidy.
Rabih, you've got thoughts?
Actually, this is the first time I hear about this, and I'll have to say I did get lost at one point, but if I'm going to do myself a favor, I want to try to summarize what you guys said and tell me where I went wrong, okay? The first point you guys said, there are 3 different types of plans. One of them, and in all 3, if you do not pay, one of them will incur all those interests and add them to your loan. The other will take half of the interest and incur it to the loan. And the third one will just forgive you on the interest, will not add it to your loan. Your loan balance is not going to grow. The second point that you guys were making, and the last one where your interest is going to be forgiven and it won't be added to the loan, it's important not to make a payment within the month, or else you would have paid it. You'd rather wait until the month is ended, or in Taylor's example, wait until the year ends and then do a lump sum. This way you avoid, like, for example, if the interest is $2,000, you avoid like $24,000 in interest by the end of the year. The third point Matt said is related to, as you accumulate those to put them as a lump sum by the end of the year, you give yourself a free choice insurance. You can decide to put them towards the loan or you don't. And I think the fourth point that Taylor mentioned that was very important is that all of this math will work if your actual payment is above what hypothetically you would incur in taxes every single month. If it is below, it's not worth it. That extra payment plan isn't really gonna drop your loan balance. Did I get it right?
Yes.
Boom.
Yes.
Great summary.
Great summary. I mean, you did say taxes instead of interest at number 4, but who's counting?
Yeah. Yeah, that last point is critical, though. To your point, is undersave. If your payment is below, that's the set payment that is, the payment that is set for you, your minimum payment, the interest balance that's due that month, then it does not make sense to make extra payments. So to your point, or to Taylor's point, Rabih, you said taxes, but you meant interest. So, but that was an incredible summary. Yes.
Yeah. Well, and the thing that was really sad about this is this was a person who came to me and they had just finished a specialty, right? And they had about $900,000 in debt, right? And they were because they'd been in school and had finished within COVID, their payment for right now was $0, right? But they owed $4,500 a month in interest, and they were paying $3,000 a month extra, thinking they were making a dent in their student loan.
Oh,
when in reality, they were only paying interest because, again, they had to be over the $4,500 a month threshold to even begin to make a principal payment.
Yeah.
Right.
Huh. Okay. Well, that's interesting. That's honestly super helpful, Taylor. So I'm sitting here thinking we should probably have an article on this. So
we do. I guess a segue here would be, we still have, if you go to dentisadvisors.com/loans, we have incredible resources. We have some webinars that we've put up on this. We've got articles. I think Victoria and Lauren both wrote incredible articles about this. We've got podcasts. We've got a YouTube video clip
and
about
we've got Taylor.
How you should be doing
I would just call Taylor.
And we've got our resident student loan expert, Taylor.
Hey, well, and that's the thing is, on that page, if you want to schedule a student loan consultation, please do.
Yeah.
Right? We do this. It's still something that happens. I had 2 of them on my calendar this week. So we want to make sure that everyone is being educated and taking full advantage of these plans, because in many instances, there was a court case in Texas that stopped $10,000 of loan forgiveness, right? Heaven forbid we give that to these people. This interest subsidy for dentists is giving, like, in
way
many
more
cases,
than that.
way more than that on an annual basis, right?
It's true.
And people are not fully maximizing what's available to them.
Yeah. Super helpful, Taylor. To your point, dentisadvisors.com/student loans. Tons of great resources there. And honestly, I don't joke. Taylor and Jake are kind of our 2 resident experts in this space. In this particular topic, I am nowhere close to that level of knowledge that you guys are. You guys have just been doing such a good job getting familiar with all the ins and outs. It's super complicated. This stuff is, I think Travis Hornsby, shout out to him. He does a great job with this. He had an analogy that every time the government comes out with a new program, they're just adding an ingredient to the sandwich. They're not removing anything, which makes it just extra complicated. Pay, repay, save, all of this stuff is so complicated. So thank you, Taylor.
It's going from like a great Jimmy John sandwich to like a overly loaded Subway sandwich.
You know what? We're not even.
We're not going there.
Taylor. It is Friday. I'm happy. I'm not going to allow that to hinder my happiness right now. We're not going to start fighting about sandwiches, but Subway, Eat Fresh, way better than Jimmy John's. Don't at me. Okay. That was a great summary, Taylor. Thank you for that. We will wrap this up with the final question here, and we'll kind of speed through this. We've talked about this a lot, but what is the biggest risk to your investment returns? This is a shout out to Ben Carlson, fan of the show. I'm just kidding, he's not. But Ben Carlson, he's an excellent financial writer. He's got I want to give a shout out to him. He's got a blog called A Wealth of Common Sense. He's also co-host of the podcast Animal Spirits. It is a fantastic show with him and Michael Batnick. But he puts out a lot of stuff. And one of the most recent ones he put out was, what's the biggest risk right now? And it was a reader wrote to him and asked that. And we've talked about this a lot. And I think the simple answer is, and he mentioned this, is from an economic standpoint or a market standpoint, the external risk probably right now is a recession. It's the thing we've been talking about for 2 years. He gave some incredible data here that I thought was super interesting to talk about. So in the post-World War II era, the economy has slipped into a recession about every 5 years on average. However, what's really interesting about this is if you kind of bifurcate the data. So from 1940 through the early 80s, the recession was about once every 3.5 years. They've started to spread out now. So Rabih's nodding vigorously because he knows all this already. But since 1990, there's been a recession once every 9 years on average. And then if you even dig down even deeper here, wasn't really even a recession. Technically, we hit a recession for 2 months during COVID. But that was, as Ben Carlson talks about, self-induced. It wasn't a normal business cycle issue or recession. It literally lasted 2 months. If you exclude that, we're looking at 15 years since the last true economic contraction in the U.S., which is pretty wild. So I'm going to stop there for a second. Rabih, I know you've got thoughts on this or comments here.
You just tickled the financial history nerd in me because you described it perfectly. Actually, the reason there's this shift between the rate of recessions pre-1980s and the shift in the rate of recessions after 1980 is due to like a structural change in our economy. It was, just to give you historical context, late 70s, we had incredibly high inflation, came into the economy, increased interest rates so much, aka forced the economy to go into a recession. But along with that, a lot of financial reforms came in. And it was the shift towards financial liberalization, neoclassical economic theory, away from the Keynesian economic theory. I know I'm throwing like academic terms at you.
I love this.
But before the 1980s, we thought that the government had to play a bigger role in managing the small fluctuations in the economy when it comes to like unemployment and price levels. They thought that fiscal policy should intervene and they should higher taxes and lower taxes whenever we think the economy is slowing down. Neoclassical approach came in and said, no, this is old way of thinking. What you need to focus on is more monetary policy. And monetary policy can definitely target the amplitude of business cycles and help smoothen out recessions, whereas fiscal policy is there to intervene as a structural change rather than fine-tuning every now and then. And because of the shifting in the economic mindset, and it's more of like an innovation in policy. It's a new way to do policy. We actually came to a new economic environment where recessions are not happening as much as they can. And to add on top of it, we haven't had inflation period since the 1970s. And just now we had to deal with it. The Federal Reserve had to deal with it. And the reason they are championing a soft landing is because it would be the next level in this improvement in policy, because they will be able to tackle inflation without forcing an economy into recession, which is a step forward in how we do it and how better we do it. So a lot is happening when you look at the progress of economic policy and how it prevents recessions and keeps strong economic growth. And this just tells us that the future is going to be better.
Love it. We're not going to dive into this now, but there is something to be said about...
Yeah, you should have stopped me.
I know. No. This is great. I'm glad you went through that for real. But there is something to be said, and we won't go into this too deep, at least on this show. There is something to be said as I sit here and listen, and we were talking about these numbers, this data of these kind of the manual removal of a risk in like we don't even... I don't think we fully grasp yet the possible risk that we are creating over time of, like, let's be real, kind of manipulation of markets and money flow and interest rates, we don't fully, like right now, we're seeing the spreading out of recessions and these shocks to the economy. But the question I'm thinking is, at what risk over the long term? And we don't know what that could be. And you're smiling because we're gonna get going, Robbie. We have to do like a 2-part series here.
Yeah. I have my points, but I'll leave them to the next time we talk about that.
We'll tease it. But here's the main point of this article that I loved. I loved what Ben Carlson did here as he wraps this article up, and we'll wrap it up with this. Because he mentions as well inflation. Like the 2 biggest risks we've been talking about for years now, have been recession and inflation. And Robbie, to your point, trying to land this plane, trying to soft land it, it's kind of this balancing act, the teeter-totter of inflation, and on the other end being a recession. And we're trying to balance that out. But what we've talked about so much, and what Ben Carlson talks about in this piece he did, is all of these risks, these market risks we're talking about, that's the price of admission. These are the features, they're features of the market. They're not a bug. The biggest risk is you as the investor. It's you actually allowing these things to knock you off your long-term course of investing. And so, as he puts it, the risk of you abandoning your investment plan or making some horrible mistake, trying to go all in on something like NVIDIA, as we joke about that, but basically breaking your own rules, thinking that, as John Templeton says, this time is different. Those are the most expensive words in investing, thinking this time is different. So the biggest risk is not recession. The biggest risk is not inflation or any of these external events that are always happening. The biggest risk is you reacting to those things and not sticking to your plan. So this was a good show, guys. We went long, but I love it. There's going to be some editing needing to be done to clean this up, probably just shorten it a little bit, but I loved it. Any final words from you guys on this or anything? Feeling good? Okay.
Wow.
We will end this like we always do, and we will until June. DennisMoneySummit.com. You should absolutely check it out. There's a lot of momentum building on this. I got asked the other day from someone who's interested in coming, like, where are we as far as attendance? We're about halfway full. I'm going to say full, not empty. We're halfway full. The glass is half full. So still room, absolutely, but there's going to be limited space. And again, I think over the next month or two, we're already noticing attendance is picking up, people signing up more. So definitely check it out. We actually have an episode coming out here with Daniel Crosby, one of the main stage speakers. It's incredible. It's going to be so much fun. And bottom line, come hang out, come meet Rabih, come meet Taylor, the brilliant brains that you
come meet Rabih. Come meet Rabih.
I mean, that's the biggest draw. We should just be highlighting that. You get to hang out with Rabih.
We should do like a table that he can sign autographs and headshots and
I agree.
take pictures.
It would make my day if a dentist comes to the event with like all their statements from their student loans and they just hand them to Taylor and tell them
they're like, hey, Taylor, here you go.
And
then their investment statements to you. And then for me, they just give me a high five. That's all I want. That's all I need. So, okay, guys, Taylor, thank you so much. Rabih, thank you so much for being here as always. That was our 2 cents. There's only one thing left to do. That is go forth, live your rich life. Until next time. Bye-bye.